Because of high inflation and the fall in the value of sterling, markets expect UK interest rates to rise very sharply this winter. Markets are pricing in interest rates of around 5 or even 6%. By historical standards, that might not sound very much. But because we've become so accustomed to low interest rates, the sharp rise in interest rates will cause a very significant consequence for households, firms and the government. Higher interest rates, of course, will increase the cost of borrowing. This will affect people with mortgages, loans and business who are borrowing. And the problem is that in the past 15 years, we have become accustomed to very low interest rates. So households and firms have taken long-term decisions based on the expectation interest rates stay low. But if interest rates were unexpectedly to rise to 5 or 6%, then it would strain many finances and cause homeowners to face repossession and firms to have to cancel investment projects. To give you an example, supposing you have a mortgage worth £270,000, which is the average house price in the UK at the moment, on a 25-year mortgage deal. When interest rates are 2%, the average monthly payment is £1,144. If interest rates were to rise to 6%, then it would mean an increase in £600 per month to £1,740. So that would be a very unexpectedly large rise in necessary spending. And as well as increasing the cost of mortgage payments, it's likely to put a strong downward pressure on house prices. Because if mortgage rates increase even a fairly small amount, it will push many people over into having to cut back on other spending to able to afford their mortgages. And unfortunately, some may see their homes repossessed because they can't keep up with mortgage payments. So this would cause a fall in house prices. And there's a very strong link between a sharp fall in house prices and a recession. Every time in the UK we've had a sharp fall in house prices, this has invariably caused a deep recession. For example, in 1991, house price crash, very influential in causing a recession, as it was in 2007-08. So when house prices fall, it causes a decline in household wealth, decline in confidence. People are left with negative equity and they lose confidence to spend because they see the value of their main asset decline. And it's not just homeowners who might see rising costs. Many housing analysts say that if interest rates increase, it would also put upward pressure on rents, because many buy-to-let investors bought houses to let on a big mortgage. So if their mortgage costs go up, they will want to increase rents to maintain the ability to pay back their mortgage. Also, interest rates are very important to business. Businesses are facing many rising costs from higher energy prices, falling value of sterling pushing up import prices. Rising interest rates on top of this could be the final straw. Another big problem of rising interest rates is that it has an unequal impact on the economy. Of course, some people will actually benefit from rising interest rates. If you've paid off your mortgage and you have large cash savings, higher rates will actually increase your disposable income and you'll be better off. But for those who have little savings, often young, a lot of loans, student loans, mortgages, then higher interest rates will have a much bigger negative impact, and it will make their financial well-being severely curtailed. And this is a problem that to achieve the goal of a strong pound or prop up the pound and reduce inflationary pressures, we're relying on higher interest rates, but it has a very unequal effect. It hurts some people a lot to achieve a target goal. And related to that, I believe that the Bank of England will be increasing interest rates very reluctantly, because when we look at the state of household finances, many people are still worse off after the recent budget, because the tax cuts went primarily to high income earners, and those on low incomes are actually still worse off because energy prices are rising in October, real wages are falling, and the tax cuts didn't benefit them that much. So if on top of this we get higher interest rates, then many households will still be really facing a very severe cost of living squeeze. So in this climate, the Bank of England won't particularly want to be raising interest rates, because it knows that for many people it will be very damaging from a financial point of view. But it's kind of been forced to increase interest rates because of the weakness of a pound and the ongoing inflationary pressures and the response of the markets. In an ideal world, you'd be raising interest rates slowly, steadily, to help to reduce a booming economy. You don't want to be raising interest rates very rapidly when the economy is heading towards recession. It's a very unfortunate situation to be in. And as we've mentioned before, the UK economy is undergoing kind of a strange situation, but it's like we have the foot on the fiscal accelerator, trying to stimulate the economy. And at the same time as doing that, the Bank of England is then putting its foot on the monetary brake, trying to slow down the economy. And it's hard to know where the economy is, which is going down harder. It's a very unusual situation to be in. So rising interest rates sometimes can be quite benign. They can help to reduce inflationary pressures. What is a problem is when you get a sudden change in interest rate policy. And when people start to remortgage, get a new 2-year fixed contract, they will be shocked at how much extra they have to pay in mortgage payments. And the main concern is that these interest rates rises will be the final straw that pushes the UK economy into a deep recession. Because despite tax cuts, much of which may be saved by high income earners, the high interest rates will very significantly reduce investment and consumer spending. Another big consequence of rising interest rates is for UK debt interest payments. Not something that everybody might be always thinking about, but even a small rise in bond yields can cause a very significant increase in the amount the government have to pay for debt interest payments. But if we spend more on debt interest payments, there's a very strong opportunity cost. We can't be spending that money on healthcare and education. Also, if a higher debt interest payments and bond yields remain, then there'll be pressure on the government in the future to reduce spending and or raise taxes, neither of which it particularly wants to do. And the interesting thing is, as an economist, we've often spent the past 15 years saying, don't worry about government borrowing. When interest rates are low, it's really quite cheap to borrow and the market has strong demand for it. And you can finance a lot of good public sector investment borrowing at low rates. But the shocking rise in gilt yields we saw in the past week or so have really changed that dynamic. And when interest rates go up like that, it really forces people to think much more carefully about what government debt is sustainable. So obviously there's a lot of uncertainty because the Bank of England have announced that they're going to buy long-term debt to try to reduce bond yields. We'll have to see the impact of that in the coming weeks and coming months. And if you're wondering why I'm making lots of economic videos, well, part of the reason is that I have a big mortgage myself. Back in 2005, I got a self-certification mortgage, 7 or 8 times my income. And I actually got it a 47-year mortgage deal, interest only. And I was very fortunate that interest rates stayed very low for so many years. But if mortgage rates do go up as predicted, then it'll be a significant extra expense I face for my own mortgage. But at the same time, I also still feel quite fortunate because I was able to buy a house in 2005. So although it'll be a big change in financial situation, it could be a lot worse. Anyway, I hope you liked this video, and if you do, please give it a thumbs up and subscribe to the channel Economics Help, and feel free to leave a comment in the comment section if you've got anything you'd like to ask. Okay, thank you, bye.